January 1st, 2026, China's silver export controls became law, not proposed, not delayed, active. 60 to 70% of global silver supply, now behind a government license. You know what else happened when China weaponized a critical material? Rare earths. 2010, prices tripled in 12 months. Japan's entire manufacturing sector scrambled. This time it's different. This time it's worse. Silver isn't just another industrial commodity. It's the most undervalued strategic asset in human civilization. And China just locked the door. Here's what nobody is telling you. This isn't about export policy. This is stage 3 of a 4-stage pattern that's destroyed commodity markets throughout history. Oil in 1973, palladium in the 2000s, and now silver in 2026. When stage 4 hits, and it's coming, the price won't just rise. It will detonate. And the global industrial system that depends on silver will face a crisis unlike anything we've seen since the oil embargo. By the end of this video, you'll understand exactly where we are in the pattern, why China's move wasn't random, and what happens when the world's most critical industrial metal disappears from global markets. Let me show you the machine. The pattern is brutally simple. 4 stages. Every commodity crisis, same mechanism. Stage 1, stability and complacency. Supply meets demand. Prices stay reasonable. Everyone assumes it will continue forever. No one prepares. No one diversifies. The system runs on trust that the resource will always be available. Stage 2, structural imbalance. Emerges demand accelerates. New uses appear, but supply cannot respond. Geology doesn't care about forecasts. Mining takes 7 to 10 years. Investment disappeared years ago because prices were low. The gap opens, slowly at first, then faster. Stage 3, recognition of crisis. Inventories drain. Insiders start hoarding. Governments restrict exports. Markets realize the deficit is structural, not temporary. Panic buying begins. Paper markets lose control. Physical metal decouples from futures prices. We are here right now with silver. Stage 4, price explosion and market break trading halts become common. Delivery failures cascade. Industries cannot source material at any price. The paper market collapses. Physical holders win. Everyone else learns an expensive lesson about owning something versus owning a promise of something. This pattern doesn't change, ever. The only variable is timing. And with China's export controls now active, the timing just accelerated. Let me prove this pattern to you. 3 times. 3 different commodities. 3 identical outcomes. Example 1, oil, 1973 stage. 1, stability, 1945 through 1970. Oil, $3 per barrel. Gas, 30 cents per gallon. The entire post-war boom assumed infinite cheap energy. Detroit built gas guzzlers. Suburbanization exploded. No one questioned supply. Stage 2, imbalanced demand soared. Europe rebuilt. Car ownership tripled. But U.S. oil production peaked in 1970. America became a net importer. New supply, years away. The North Sea wouldn't come online until the late 70s. The gap opened. No one noticed because price stayed stable. Stage 3, crisis recognition. October 1973, Yom Kippur War. OPEC embargo. Oil prices quadrupled in weeks, not just the embargo. The brutal realization that cheap energy was finished. Gas lines formed across America. Production slowed. Refineries couldn't get crude. The world recognized the era of abundant oil had ended. Stage 4, explosion oil went from $3 to $35 per barrel by 1980. 10 times in a decade. Inflation ravaged economies. Central banks lost control. Entire industries restructured. Those who prepared survived. Those who assumed stability would continue got destroyed. Same pattern. Example 2, palladium, 2000 to 2020. Stage 1, complacency. Throughout the 1990s, palladium was cheap, boring, ignored by investors, a byproduct of platinum mining. Nobody cared. Stage 2, structural demand surge. Early 2000s, emissions regulations tightened globally. Palladium became the preferred metal for catalytic converters. Demand exploded. Problem? Palladium is a byproduct. You cannot just mine more. Supply is structurally inelastic. Russia supplied 40% with no incentive to flood markets. Stage 3, physical shortage. By 2019, 8 consecutive years of deficit. Inventories gone. Russia delayed shipments. Paper contracts tried to manage it. Physical markets decoupled. Automakers couldn't get metal, not at any reasonable price. Stage 4, price detonation. $500 per ounce in 2016. $3,000 by 2020. 6 times in 4 years. The only correction came when automakers substituted platinum at massive cost and efficiency loss. When physical supply cannot meet industrial demand, price is the only adjustment mechanism, and it's never smooth. It's violent. Same pattern, different commodity. Example 3. Rare earths, 2010. Stage 1. Ignored dependency. For decades, rare earth elements were cheap. China produced 97%. The world consumed them in electronics, defense systems, wind turbines. No one diversified supply chains. Stage 2. Monopoly. Realized China controlled production, processing, refining, the entire supply chain. But global demand accelerated. Electric vehicles, renewable energy, defense contractors. Stage 3. Weaponization. September 2010. Territorial dispute with Japan over the Senkaku Islands. China halted rare earth exports to Japan. Overnight, Japan's manufacturing sector faced shutdown. Toyota, Panasonic, Hitachi, all depended on Chinese rare earths. Prices tripled in 12 months. Not because of scarcity, because of weaponization. Stage 4. Forced restructuring industries scrambled to diversify. New mines opened in Australia. Recycling accelerated. Strategic reserves built. But it took years, billions in costs. And China still controls 70% of processing. The lesson? When one nation controls a critical resource, they can weaponize it, and markets break. Now apply this exact pattern to silver. Right now, January 2026. China just implemented the most aggressive silver export controls in history, January 1st, 2026. Active. Let me show you stage by stage why we're deep in stage 3. Stage 1. Complete. Decades of complacency. For 40 years, silver was absurdly cheap. In inflation-adjusted terms, silver today costs less than it did in 1980. 45 years of monetary expansion, industrial growth, technological revolution, silver got cheaper. Why? Massive deposits developed in Mexico and Peru. Governments sold reserves. Everyone treated it as boring industrial commodity. Complacency. Total. Stage 2. Complete. Structural deficit. According to the Silver Institute, 5 consecutive years of deficit, 2021 through 2025. Cumulative shortfall, 796 million ounces. Nearly 1 full year of global mine production gone. Industrial demand hit record highs in 2024, 680 million ounces. Photovoltaics alone consume 200 million ounces annually, up from 85 million in 2020. Electric vehicles use twice the silver of combustion cars. 5G infrastructure, AI data centers, medical devices, electronics. Industrial demand, 1 billion ounces per year. Global mine production, 813 million ounces, flat to declining since 2016. The math doesn't work. Consumption exceeds production every year for 5 years straight. Supply is inelastic. 70% of silver comes as a byproduct of zinc, lead, and copper mining. You cannot just mine more silver. You mine base metals and hope silver comes with it. Base metal prices, choppy. Mining capital expenditure, multi-decade lows. No new supply coming. Zero. The structural deficit is real, verifiable, undeniable. Stage 3. Active. Right now, crisis recognition. Here's where it gets critical. China's export controls aren't random policy. They're recognition that physical silver is disappearing. The new rules? Effective January 1st, 2026. Only large state-certified companies can export. Minimum annual production requirement, 80 tons. Credit lines around $30 million. These measures eliminate small and mid-sized exporters entirely. China controls 60 to 70% of global refined silver supply. When China restricts exports, international availability drops immediately. And they're using the rare earths playbook. Graduated escalation. Reduced quotas first, complete prohibition if needed. Weaponizing dependency. Now look at the market response. Silver prices, record highs. December 28th, 2025. $83.90 per ounce, new all-time high. Broke the 1980 record of $49.95, 190% gain since January 2025. COMEX, registered silver, down from 400 million ounces in 2020 to under 60 million today. 60 million ounces equals less than 3 weeks of global consumption. Physical premiums rising, delivery times extending. Chinese buyers offering $8 to $10 above spot just to secure metal. Indian importers paying premiums. European dealers reporting shortages. The paper market is losing control. 100 ounces of paper silver traded for every 1 ounce physical. When delivery is demanded, the metal doesn't exist. We're watching the exact pattern play out. In real time, industrial users are stockpiling. Elon Musk warned on X, this is not good. Silver is needed in many industrial processes. He's right. Solar manufacturers need silver. Defense contractors need silver. Electronics companies need silver. And China just locked up 60 to 70% of supply. Stage 3, active, undeniable. We're not in stage 4 yet, but we're at the door. Here's what the next phase looks like. And it won't be gradual. A major industrial player publicly announces they cannot source enough silver. Solar manufacturer, defense contractor, electronics firm. That triggers the cascade. Other firms panic buy. Governments secure supply for strategic industries. Investment demand explodes. The paper market breaks. COMEX changes rules. Restricts delivery, forces cash settlement. It happened in 1980 with the Hunt brothers. It will happen again. When physical decouples from paper, when industrial bid meets monetary bid, when solar panic combines with currency crisis, silver won't rise steadily. It will gap 50 to 75, 75 to 100, 100 to 150. These aren't predictions. These are logical outcomes of supply-demand math in a market with no inventory buffer. And China's export controls accelerate everything. Destruction of counterarguments. You'll hear, technology will save us. Substitution. There's no substitute for silver in solar panels that maintains efficiency at scale. Copper oxidizes. Aluminum doesn't conduct well enough. You cannot engineer around the periodic table. Recycling. Recovery rate from electronics is below 20%. Too small per device to be economical. Solar panels last 25 years. That silver isn't coming back soon. New mining takes 7 to 10 years to bring a mine online. We don't have 7 years. The deficit is now. And silver grades are declining globally. Demand destruction? The only way demand falls is if the energy transition stops. And the transition is mandated by law across Europe, China, and the United States. Trillions in subsidies committed. Entire industries retooled. Policy doesn't care about silver prices. You'll hear, China won't really restrict exports. They need the revenue. Wrong. China exports around 4,600 tons of silver annually, imports 220 tons, net exporter. But domestic industrial demand is growing faster than exports. Solar installations in China dwarf the rest of the world combined. Electric vehicle production, 5G infrastructure. China needs that silver domestically. Revenue from exports? Meaningless compared to securing industrial capacity for domestic manufacturing. They've done this before with rare earths. They'll do it with silver. You'll hear, the market will find equilibrium. Eventually. But the path to equilibrium when supply is physically constrained isn't smooth price adjustment. It's violent dislocation. Industries that cannot source silver will shut down production lines. Solar panel manufacturing will slow. Defense contractors will face delays. The electronic supply chains will break. Price will spike until demand is destroyed. That's the equilibrium. And it's catastrophic for unprepared industries. Here's what people miss. Wealth doesn't disappear in commodity crises. It transfers. From those holding paper to those holding physical. From those who ignored the pattern to those who recognized it early. In 1973, oil futures traders got crushed. Physical oil holders made fortunes. In the 2000s, palladium paper contracts settled in cash. Physical palladium holders controlled supply. Silver will be the same, bigger. Exchange-traded funds hold 440 million ounces. Or so they claim. Read the prospectus. They can settle in cash if physical isn't available. Your silver might just be a promise to pay you money if silver goes up. Not actual silver. Futures contracts, 100 paper claims on every physical ounce. When delivery is demanded, most contracts get cash settled. Against the holder's will. Physical silver in your possession? That's ownership. No counterparty risk. No settlement risk. No exchange can change rules on metal you hold. When stage 4 hits, when trading halts become common, when delivery failures cascade, people holding physical silver will watch from safety because they already won. This is not investment advice. I'm not a financial advisor. Do your own research. Consult professionals. But if you understand the pattern, here's the logical framework. First, understand the difference between speculation and protection trading paper, silver for quick profits. That's speculation. Know the risks. Buying physical silver as protection, store of value, insurance against supply crisis. Only one option. Physical metal in your possession. Not in a vault you don't control. Not in an ETF. Not in futures. In your hand, in your safe, where you can see it, touch it, secure it. Second, timing matters. Physical silver available today at $3 to $5 over spot. When the squeeze accelerates, premiums will be $20, $30, $50 over spot. Eventually, none available at any premium. Dealers sold out. Mints with year-long wait lists. You'll be standing there with cash losing value, unable to convert it to the one asset gaining value. Chinese buyers are already paying $8 to $10 over spot. That's the warning. Third, focus on recognizable forms. Silver coins, Silver bars from major mints. Don't buy collectibles. Don't buy numismatics. Don't buy fancy premium products. You want pure silver content in forms anyone anywhere recognizes. American Silver Eagles, Canadian Maple Leafs, 100-ounce bars from recognized refiners. Liquidity matters when the system breaks. Fourth, scale appropriately. This isn't about going all in. This is about allocation. Take 10, 15, maybe 20% of assets and convert to physical silver. Enough that if the pattern completes, you're protected. But not so much that if something unexpected happens, you're destroyed. Balance caution with action. Fifth, store properly home safe. Bank safety deposit box if you trust the bank, private vault if you prefer. Make sure you control access. No third-party custody where someone else holds keys. The entire point is removing counterparty risk. Don't reintroduce it through bad storage. China's export controls took effect January 1st, 2026. Active, right now. Global silver deficit, fifth consecutive year. 95 million ounces in 2025 according to Metals Focus. COMEX registered silver, 60 million ounces. 3 weeks of global consumption. Silver price hit 86.62 on December 30th, 2025. Pulled back to 72, still up 150% year to date. Industrial demand, record highs, photovoltaics, electric vehicles, AI data centers, defense systems. Supply response, flat. Mine production unchanged. No new projects coming online in any time frame that matters. China's strategy, clear. Lock up 60 to 70% of global supply. Prioritize domestic industrial use. Use export licenses as geopolitical leverage. The pattern is accelerating. The window is closing. This isn't about predictions. This is about mathematics. Consumption exceeds production. Inventories are depleted. China controls 60 to 70% of supply and just restricted exports. Industrial demand is mandated by law. Energy transition, electric vehicles, 5G infrastructure. These policies won't reverse. Physical silver cannot be printed, cannot be created with policy, cannot be algorithmed into existence. Physics doesn't care about economic models. When industrial bid meets investment bid meets supply shortage meets export restrictions, there's only one outcome. Price adjusts, violently. The people holding physical metal when that adjustment happens will be on the right side of the wealth transfer. Everyone else will be learning an expensive lesson. January 1st, 2026, China's silver export controls became active. 60 to 70% of global supply. Behind government license. Graduation escalation possible. Complete prohibition if needed. The pattern is clear. Oil in 73, palladium in the 2000s, rare earths in 2010, now silver in 26. Stage 1, complacency. Check. Stage 2, structural deficit. Check. Stage 3, crisis recognition. Active right now. Stage 4, price explosion and market break. Coming. Every fiat currency in history has failed, every single one. Average lifespan 27 years. The dollar? Fully fiat since 1971, 54 years. We're on borrowed time, and you cannot print silver. So here's my question. Are you going to wait until the market breaks and wish you had acted? Or recognize the pattern, trust the data, and do something while there's still time? The choice is yours, but the window won't stay open forever. If this connected dots you've never seen connected before, subscribe right now, because what I've shown you is just the beginning. China's export controls are one symptom of a much larger systemic failure. In the next video, I'll show you how deep this goes. The rare earth stranglehold, the critical minerals crisis, the supply chain weaponization, all following the same four-stage pattern, all headed to the same inevitable conclusion. Subscribe, turn on notifications. What comes next is the largest resource war in modern history. And people who see the pattern early don't just survive, they thrive. The clock is ticking, and China just locked the door.